Hello, everybody, and welcome to Mindprint Hash for week 17 of 2026. I'm your host, Cameron Otsuka, along with Matt Dines. There's been a lot of headlines this week. I know Matt and I were trying to put together topics for this episode, and there's just so many things to try to narrow into a core few to talk about with all of you this week. But um, ultimately, we want to focus on some stress that we see materializing at the central banking layer and on the resource procurement front. So today's episode will touch on those central bank headlines, both internationally and domestically. Then we'll move on to some spheres of influence competing for resources. And then Matt's got some, I think, synthesizing chart deep dives around gold to final out today's episode. So Matt, let's start on the central banking front. The Iran fallout as of late has really moved out of that military kind of kinetic zone and moved into this financial layer. It seems like a lot of central banks have been kind of cornered into the what you're calling the bad quadrant. So soft growth, high energy linked inflation, and ultimately more FX uncertainty. So, what has been the response from central banks so far? And maybe we start with what you've been seeing internationally across the world.
So just to frame this first block, we're talking about, Cameron, as you introed, that whole panic and kind of reaction to the Iran war front turning into a blockade of the Suez Canal and the limitation of the commodity exports from the Persian Gulf to the rest of the world has created tightness, not just in the resource markets themselves, as every economy across the globe, which vary on a sliding scale on how dependent they are on imports of natural resources that they don't have access to within their domestic sovereign economies. Are on some sliding scale having to react to that tightness, and so that now has trickled in to the central banking layer at like each of these aggregate economies roll-ups of their own local currency system. So you see it in the euro, the ECB, you see it in the Bank of Japan, and we saw it this week at the Fed. So to dive into it, we're going to start with the Bank of Japan today. And we're going to end on, the most important one, the developments we saw at the Fed. But to start with, so this morning, Thursday, as we're recording, we got the intervention, right? The FX intervention support from the Ministry of Finance in Japan to strengthen the yen. As we all know, for the last 3-4 years, the yen has been in a secular sell-off. It's been threatening that 160 Japanese yen to the US dollar support line. And the trigger for this intervention, which amounts to central authorities in Japan buying yen and selling dollars. So it's yen strengthening or dollar weakness. We're not going to talk about the DXY index, but or too deeply or throw up the charts. But the pressure here is towards a weaker dollar after we just saw a strengthening impulse in the dollar as that tightness I talked about coming out of the Iran situation worked its way up to a head, and now central banks have to react. So the yen, this was really set in motion by the Bank of Japan's policy announcement on Monday evening on U.S. time, that the Bank of Japan's response to this commodity market tightness and also the tightness in global money markets, short-term access to currencies, dollar, euro, yen, et cetera, for overnight and short-term funding. The Bank of Japan, just to set the stage here, every economy is facing an inflationary impulse, not in the terms of the monetarist definition and expansion and credit and money supply, but in the way that everyday people have been trained to talk about inflation as a rise in prices. But we've seen that rise in prices on the back of this resource tightness coming out of the situation in the Persian Gulf. And every central bank is now having to come up with its own prescriptive plan at these April meetings to address that pressure, right? So the Bank of Japan's approach was they announced that they are going to hold short-term rates steady. They're sitting right now at 75 basis points, and Chairman Ueda elected not to hike 25 basis points on Monday afternoon's policy announcement. And what that led to was, and you know that's the case, right? Because in their summary of economic projections, they increased their inflation target in terms of rising prices in the domestic Japanese economy for the 2026 calendar year, right? So they knew they took this trade-off. We are not going to hike in what is right now a secular hike cycle for the yen. The Bank of Japan is on a hiking path, which is kind of off cycle from what you see in the United States or Europe, right? We were in a cutting cycle, and
Right.
like rates are on a downward trajectory on the front end, is where policy naturally needs to go, or where money markets are guiding policy. In Japan, it's the opposite. They're on that hike cycle phase of their own trajectory. So Ueda's decision in the Bank of Japan not to hike in the midst of like a broader hiking tailwind, that itself was a tell that they were willing to play nice with the international community. In my read on this, they were not go. They elected not to increase rates, which pulls capital from the global money markets into their own domestic financial system, in the backdrop of an environment where everybody is after the short-term dollars, that monetary tightness, in the face of competition for resources, as one kind of supply nexus is temporarily taken off the board with the Iran and Strait of Hormuz situation. So what Japan did, they decided to play nice. All else equal, you're going to get a rise in inflation in the Japanese economy, which is amidst a broader secular inflationary backdrop in the Japanese economy itself. And the reaction, then the follow through to that, came this morning with the FX intervention to prop up and strengthen the yen. So the last detail I want to talk about there, the articles, we show this Bloomberg one. We usually don't go through the full text, but they specifically mention before they conducted this activity, the Ministry of Finance, they coordinated and kind of pre-announced it or ran it by their counterparties in the U.S. So Japan, we've talked about this in the past with the Takaichi government. They are simpatico with the U.S.'s 47th administration. It just goes to kind of reinforce that idea that Japan is a friendly dance partner to the U.S., who is the one leading on the steps, Japan kind of following, also kind of dancing on their own and doing what they need to do, but they are a friendly dance partner to the U.S. We'll leave that one there, but it was a big development right here in Japan, that intervention you saw on Thursday morning. This was, rumor, like we've been hearing this rumor of intervention. It was coming. We had that, remember, think it was December or January, we had that rate check conducted by the BOJ officials. This was the arrival here as of this morning, April 30th. All right, next we'll shift focus to Europe and the ECB. They announced at their policy meeting this week they're also not going to hike, but they are telegraphing that, hey, if this tightness persists, don't be surprised if we need to hike in June, is what they're saying. So slightly different than the Japanese perspective of we're going to play nice, we're going to accommodate, but also, hey, we're going to intervene to strengthen the yen as necessary. Europe is everybody's facing their own, unique circumstances as far as their position on the game board and reaction to this acceleration of these bigger picture events unfolding into the next stage, which Iran was the catalyst for, or was a key catalyst ECB is saying, hey, well, we may start actually hiking rates to accommodate that monetary tightness and drawing more capital into our banking system, our money markets, et cetera, and ultimately strengthening the currency through a different means or mechanism than what we just saw with Japan. But ultimately, what this is signaling in my mind is this policy path is kind of an indication that the ECB officials recognize that their economy is on a much weaker footing from an underlying growth and demand standpoint than, say, a relative peer in Japan. And then if you want to juxtapose that with the United States, just much further behind in terms of the growth potential, demand, underlying, strength and resilience. Okay, so just one other piece of information here we've seen in the last week. This isn't central banking, but you saw from Brussels partnership with Frankfurt, where the ECB is based, the technocratic complex from the political bureaucracy standpoint, echoing what you see from the technocratic bureaucracy and Frankfurt from the financial dimension. You saw this program launch with the heading or with the title Accelerate EU in response to this entire resource tightness, the problems with domestic economic growth. And the answer from the EU, as it generally tends to go with the post-war technocratic kind of mindset, was to launch a new program management spin up called, hey, Accelerate EU, to strengthen EU's energy resilience in the face of tight energy and other natural resource commodity exports from the Persian Gulf. So those two programs working together are kind of a good indication of the cards that Europe, both the ECB and European Union and the European Commission, et cetera, holistically, what Europe is holding in this kind of game we kind of analogize to like a poker table all the time, I think is an apt metaphor. But those two were big tells. Yep. All right. Last, let's go to the big kahuna. We're going to talk about the Fed and what we saw at kind of a historically messy April meeting that we just got the Powell press conference on yesterday. So to start with, from the policy prescription and the all the variables that these committees manage on the FOMC, short-term interest rates, balance sheet, runoff or expansion, all of that, no real changes to report. The news here is actually in the political details that really point to a boardroom battle going on for control over the Fed, right? The key monetary policy institution for the United States. So start with a vote. You got 4 dissents. One of them was your classic dissent from Stephen Moran, Trump appointee, who is sitting. I'll just note this because it's important. It'll come up in the Warsh confirmation process as the new chair. Stephen Moran was appointed into a stub term that Adriana Kugler had filled up until August of last year, 2025, as a Biden era appointment into what was already kind of a stub seat. So the term on this seat, these board of governor seats, they're 14-year terms, which is like massive, right? In terms of like political seats, it's like, all right, job security. Supreme Court justices for life. Fed Board of Governors for 14 years is like the next highest job security in Washington, D.C., as far as I'm aware. But these things last a long time. Okay, so Stephen Moran's seat that he is occupying on the Board of Governors technically lapsed at the end of January 2026, right? And by convention, like on the FOMC, operating procedure, or what do they call those? Whatever they operate their board by, Robert's rules, whatever. He can sit in the meetings and vote in that seat while not being nominated and confirmed for that new 14-year term until a new appointee is presented by the president and confirmed in Congress to occupy that seat. So right now he's just kind of a holdover, warming that seat as a placeholder on a tentative basis, but he's still showing up and voting in these meetings. And so his vote, he's been in dissent every meeting that I'm aware of since December, where he's lower rates. We need lower rates, lower them more every single meeting. Now, the interesting thing this meeting were 3 dissents from Beth Hammock, Neil Kashkari, and Lori Logan. They're not on the board of governors. They're on the rotating seats for the Federal Reserve Bank presidents. And there's 5 of those on committee. And what's interesting here is 3 of those 5 dissented. So they represent the regional banks that aggregate up into the bigger Fed, right? The central mothership in Washington, D.C. And the other 7 board of governors are all political appointees, right? So the interesting thing here is you saw from the regional banks themselves, they actually dissented, but not necessarily on rates or policy themselves, but they supported the decision to maintain the target range for the Fed funds rate. So don't move short-term interest rates at this point from their current levels. They specifically noted that they did not support the inclusion of an easing bias in the statement at this time, right? So opposite of the Stephen Moran dissent, rates need to be lower. Regional banking system is saying, actually, we shouldn't be easing right now, which is hinting at, so if you think about the net dynamics of what's going on, or at least the impact on United States business, and then that'll translate into the banking layer, due to what's taken place in Iran and the Persian Gulf situation since February 28th. We've seen this on the charts. All of those tankers that can't, transport commodities, goods out of the Persian Gulf to their normal consumption markets, that demand is showing up in the Gulf of America, loading up oil tankers, loading up, resources for import into other markets around the world. So it's been a positive tailwind from the U.S. business perspective. And what that amounts to is more dollars flowing in to the U.S. Banking systems that these regional Fed presidents are seeing on the ground. They're like, whoa, we're seeing
A lot of this
we're
is coming in,
seeing we're seeing deposits show up. We're looking flush here. We don't need to ease, is I think what I would take away from their first glance statement. They're like, yeah, we don't need that easing bias right now, guys. That is technically different, though. That's a supply question of money, but it's different than what the short-term interest rate should be for an ideal monetary policy. 2 related but distinct variables here. So there is a way, in my mind, where both Stephen Moran and the 3 regional Fed presidents can both be directionally correct here. All right. Now, this is where the rubber meets the road here. The big drop captures all the headlines, right? Because it's one of those things, if you just look at the variables, Fed funds rate doesn't change, balance sheet policy doesn't really change. It's just wait and see. Nothing ever happens type of thing. The money shot here was Powell answering in the press conference that he intends to stay on as Fed governor after his term as Fed chair ends on May 15th. So from a parliamentary procedure standpoint here, the way this board process is going to work, Jerome Powell has dug down. He says, I'm going to stay on and I'm going to hold that board of governors seat, which technically he can hold that until his term expires in January 2028. So his actual seat he's in started in 2014, and it finally that occupation will end in 2028 is how this works. But he won't be chairman anymore. He'll just be one of seven. Um, so what happens here, what Trump is going to have to do, and the White House is going to have to do to get their new chairman nominee in place, they have to nominate Kevin Warsh, who is the choice, first as Fed chair, but then they also had to nominate him to that Board of Governors seat that currently Stephen J. Moran is occupying, but isn't renominated for. So it's an open seat. Kevin Warsh is going to go into that. Stephen Moran will take that hat off and the dual hat, like he was, prior to serving on the Fed Board of Governors on that Adriana Kugler seat after she resigned in August. His role was economic advisor to the 47th administration. He'll go back to wearing that hat in his full-time job, is my assumption. Warsh will plug into that seat, and then Warsh will be he'll be nominated, confirmed on both, get that seat, and then confirm in that chair. But what this amounts to in the boardroom battle, it's a fight over those 7 Board of Governors seats, which ultimately those 7 seats control the majority of the 12 votes for monetary policy on the FOMC, and then the regional banks control the minority position with 5. So you see 2 battlefronts kind of opening up. This is the most unorganized mess of a state I think the Fed board or the FOMC has ever been in, and it's we'll dig into the history here. It's if it's not an all-time high in disorder, it's very close. And granted, that's 100 years, or no, FOMC was like a Roosevelt era 1930s invention. So it's like 90 years of history and my understanding on it. We'll let the fact checkers dig that up. But high degree of disorder here and political disarray. Now, how this is being presented in the mainstream, financial reporting with Jerome Powell's decision yesterday is, pretty much following a general line that this is a Powell versus Trump story. Jerome Powell is standing up to, Donald Trump, king, and he's standing in the way of an overreaching executive branch, all of that. My read on this, that's not correct. And for me to say I'm distrustful of the mainstream media and the narratives that they spin these stories with. Most of you who've been watching us for any more than a few weeks will know that that's something I tend to do to question narratives, so no one will be surprised. But I think that presentation that this is a proxy battle, Jerome Powell standing up as the noble David to Trump's bully Goliath, that is it's not even oversimplification. It's a twisting of reality, in my opinion and understanding of the power dynamics, that is serving someone's end. Now, when I get into saying the someone, let's dive deep into the background of the power factions and capital bases that Jerome Powell and Kevin Warsh distinctly represent. So we'll start with Jerome Powell because he's status quo, right? He's the legacy incumbent Fed chair. Jerome Powell's background, while he looks very similar to Kevin Warsh on the face of it. They're both lawyers, served on Wall Street. Jerome Powell notably worked as legal attorney for Carlyle Group's industrials division for a time in the late 90s into 2000s. We've discussed on previous episodes. Kevin Warsh did the same thing. He earned his Wall Street chops as a practitioner, working on M&A as an investment banking lawyer for Morgan Stanley in his pre-public policy Fed career. After that, he served in the Bush White House, Bush II, right? The George W. Bush White House is my understanding, and then was nominated to a Fed Board of Governors seat in the late George W. Bush era and exited early 2010s in the post GFC, uh, basically a disagreement with the board and its broader policy and the monetary policy framework to addressing or getting out of the
I see.
aftermath of the 2008 global financial crisis. Okay, so that similarity in my mind is uh, where this and background is where this ends. So if you look at in terms of wealth legacy and approach to markets, this is where the divergence starts to become crystal clear. So Jerome Powell, while he does come from like a legacy American stock lineage background, he's not in the same kind of upper tier hierarchy that Kevin Warsh comes from. My understanding, this has been widely reported in the media during the confirmation processes, but there's no secret about this. Kevin Warsh is, publicly worn this on his sleeve. There's no getting away from it. He's, a member of the highest of the high net worth type of America. He married into the Estee Lauder family fortune. That is distinct, though, in my mind, from a different class of nouveau riche. Well, and I'll talk about it from the technocratic faction, if you will, in the post-war bureaucracy kind of framework that we talk about, which I think Jerome Powell aligns with much more closely. So start to set one more dimension here, the approach to capital markets and monetary policy. Kevin Warsh notably disagrees with the kind of, call it the PhD standard consensus approach to Fed governance and monetary policy when it comes to things like the new Keynesian economic framework, Phillips curve modeling, what else? QE, like just basically management by ivory tower academics, where the map is very clearly not the territory, right? And I'd say that's how like Jerome Powell still kind of aligns himself and buys into monetary policy management according to that kind of incumbent technocratic framework. He's notably raised that he disagrees, or at some points you can tease out some hints that he doesn't trust these models. But if you see the alignment here between that kind of old guard and then to classify this thing as the opposition to that framework, that is like a key dimension on the different capital bases and power bases that Jerome Powell and Kevin Warsh represent. And to make this more clear, I'll just highlight one more kind of observation that I see. So Kevin Warsh doesn't agree, like he doesn't invest his wealth, let's say, in the classical framework or the what would you just call it, like the Markowitz modern portfolio theory framework or modern monetary theory kind of framework, where you just say, hey, you invest in passive index funds in the markets and then deploy into 60/40 stocks and bonds, that sort of thing. Kevin Warsh sees investment and capital allocation more in terms of actually running a business and thinks about this from an entrepreneur's first framework or the capital owner's kind of framework on deploying investment into risk from like a first principles position, as opposed to just, hey, you take the efficient markets hypothesis as generally true, deploy into the market broadly, and accept beta as a true measure of risk, and bonds, U.S. Treasuries as your uh, assumed risk-free rate, dial the sliding scale, accordingly. That's a huge divergence, and I don't think I did a good job explaining it. But those very clearly separate these two groups. That, like, if you actually think about this story deeply, you can see it. There's two separate camps there, and they are represented by their apex predator here. Or think about this as like trial by
Their
combat.
champion.
The
Yeah.
champion in the central banking representation here on each approach's view, or each of these factions' view, is who they nominate for their vision of uh, the exemplar, prototypical central banker par excellence.
Right.
That faction I talked about of the legacy technocratic class, that's Jerome Powell is their champion, and this other class, I don't know, we call them like earned wealth. They earn their wealth through actually running businesses, um, providing goods and services to the real economy, things that people demonstrate a need or like a demonstrated desire to part with money in exchange for said good, which or service which they show they value. Um, that approach is entirely different to that technocratic kind of mindset, and it reveals itself in how you think the FOMC, or a central bank, should conduct monetary policy. So their central bank champion that they've proposed here is Kevin Warsh. He's been on the sidelines since 2012, 2011, when he said, "I'm out of here. I'm not going to deal um, with this path that it's very clear that the boardroom power consensus has shifted out of that camp's favor, and was
Right.
going to go along this Ben Bernanke, Janet Yellen, QE focused approach, technocratic approach." So he sat it out for 14 years. And as you think in markets, right? Look at a chart, they go through advances and retracements, et cetera. That time for consolidation and the horse trading, the technocrats had their way post 2008 up until, I don't know if we have broken out of it for sure, but there's a huge tug of war going on in this boardroom battle. What we're seeing right here, Trump himself, if you remember, he nominated Jerome Powell as his Fed chair to replace Janet Yellen. I want to say in 2018, it was 2017 or 2018. And he was advised to do that by some faction, and you could hear it in his comments. He's like, "Great advice, guys," like sarcastically. "Thanks for that one." But he's now, Trump himself has now aligned. It's very clear. There's this choice here of the technocratic establishment, or this other choice here of your, I mean, you call them upper class, right? They come from the upper tiers of wealth
Middle.
and
Yeah.
society. It's different, though, in my mind.
Yep.
That's not a strike. Wealth is not a strike against you, and I think this is a mindset we need to get across. What I think people are, the American public, are disgruntled with, upset with, etc., is wealth obtained through invalid, inappropriate means, cheating, etc. Let's just say, as an example, waging fraud to run a daycare, overbilling, the federal government for some, policy junket just because it's there, and you won't get detected. I think that type of wealth extraction is what the broader American public is upset with. It's very clearly unfair, and one camp of those people, like that is the separator. Is how I'll put it. Like, I didn't crystallize this perfectly for the audience, but I hope it gets through what I'm saying. If you obtain your fortune by delivering, makeup and products that women around the world want, in my view, and I think in the general public's view, we're happy for that person who makes wealth in that type of way. You can say things for any product that people desire and find value of.
Right.
When you're doing it based on insider trading or using your own internal information or access to power or power itself to monetize and enrich yourself. I think that's a clearly different thing, and that's where a lot of this um, dissatisfaction with the politics, with the political situation as it stands in the United States is really deriving from. All right, so I'll leave that there, but I think that's key. I want to just put a pin on it. This isn't a Trump versus Powell proxy war. The media is going to present this as Powell is your hero. He's standing up to this bully Trump, who is operating as a king, as a tyrant, outside of his executive authority, which, in my opinion, doesn't really hold up to reality. He's actually limited in his executive authority, and he's limited by a Congress that is specifically dragging its feet from actually doing anything. So there's very clearly limitations on his exercise of power, as far as what the Constitution permits for the executive. All right, we'll leave that there. But this is a Powell versus Warsh Proxy War, in my opinion, is how I think it needs to be framed, and that represents the broader conflict at for control of the steering wheel of the FOMC, which is really just one proxy war. We see in the same process playing out across pretty much every major institution that the United States political order, economic order, all of that is really built upon. So when we talk about the institutional crisis, all of that, this is the elephant in the room going on. It is much bigger than a Trump thing, and to just put Trump in as the object to beat up as the pinata in the mainstream media to cover up these underlying problems. Don't fall for that trap, is my opinion, as you read through this process of the Fed Board of Governors shuffling that's going to take place here in rapid order over the next 30 to 45 days. All right.
So let's move to our second topic. And I think we're still on the central bank theme, right? Just to start us off, I think it's actually a really good bridge here. But the resource competition that's going on between different spheres of influence. And Matt, we've been talking a lot about EU, Bank of Japan, US. Let's talk about what's going on with the UAE, and specifically first the news that came out that first off, the UAE has exited OPEC, which I never expected. But Matt, you read a little bit deeper into this than I initially did on the headline. So maybe talk through, how does this relate to kind of what you're seeing on the central banking layer from the UAE?
Yep. So UAE being a member of OPEC, right? Think about this as like a sacrifice of sovereignty of your domestic economy, right? What you agree to in OPEC is to abide by production quotas, is how their policy has typically been set of the member states, and what it amounts to is a constraint on your own energy sector's exports of commodities into the global markets, and the supposed or purported benefit of that is you get better pricing as a block and better economics if you stand up and aggregate as kind of the union approach, and you band together for better economic terms for your exports. Now, what that represents at the end of the day as a cartel is a restraint of production in most cases. This framework works in a world where energy markets are all else equal tend to be an oversupply, right? So finite demand, oversupply. All the countries agree to curtail supply so that they do better on price, and by cooperating, every member's kind of economic floor gets raised. We're in a different era at this point, but I think at the end of the day, what this amounts to, if you think back to the story 2 to 3 weeks ago, right? Leaked in the financial media, um, pretty much not well kept secret that the UAB central bank uh, wanted U.S. dollar swap lines with the Fed or U.S. Treasury as counterparty. So that access was very clearly something that UAE wanted. We've talked about this. You can see it in my interview with Nick Bhatia on the Bitcoin Lair on Tuesday. We'll link to that video. But UAE has a dollar peg currency like most GCC nations. And this is just like part of that broader process playing out that we've talked about on prior episodes, where the dollar is still needed in international trade, right? They all these countries, they need to settle themselves, but they don't have like any stability on the financial layer, like the foundation of the financial layer to trust each other to ultimately settle with. And that's where the dollar comes in, and where everybody's kind of mutually agreed to opt in and piggyback on the U.S. economy and the U.S. dollar at the end of the day, to anchor their own financial systems, but really to like really facilitate their bilateral trade with each other. So in the past, let's say 1945 to 2020, all of this bilateral international trade could get away with denominating itself in dollars on this offshore dollar standard without ever interacting with the domestic US financial system. So what you would essentially see happen, more and more dollar credit gets built up in the offshore dollar credit bubble. But when push comes to shove, all of that debt, when it comes time to settle or service itself, when push comes to shove, whenever the global economy gets in a pinch and that credit expansion starts to peter off, it's been completely reliant on the U.S. domestic economy, the U.S. taxpayer, the U.S. Treasury, and the Federal Reserve to bail them out at every step of the way. That might mean lower rates from the 1980s, secular bull market in dollar interest rates. But post 2008, we've seen it more and more turning into QE, which is like monetization of this offshore dollar bubble. So what this represents, take this into account, this UAE story to leave OPEC. It's bending the knee to enter into that swap line with Washington, D.C. and New York, and anchoring in directly to the domestic U.S. financial system, so that now there's actually a cost, or there's a cost to the rest of world if they want to use the U.S. dollar and piggyback on top of those domestic financial structures and public institutions in the U.S. economy kind of more broadly. But this UAE concession to exit OPEC, that frees them up from this international energy cartel. It brings a major supplier of energy resources into this new orbit, which, Cameron and I, we've focused in on Pax Silica starting with last week's episode. And this old world of trade and offshore dollar dominated financial flows is clearly transitioning into its new state. So that was a huge development from the UAE itself this week, plugging into the bigger picture of this major transition going on that Cameron, you and I have really isolated. If you want to take all of these trends and put them together, I think Pax Silica is the label we put on it for the blueprints of the new architecture.
Yep, and I added in here just kind of who else might want a dollar swap line? Already confirmed South Korea. last year, actually, September 2025. There were reportedly talks between Besant and South Korea's representative on how they might actually implement something like that. As of right now, that is not, not in place. But obviously, South Korea is also interested, also impacted by everything going on with Strait of Hormuz. I think last episode I mentioned, some plastic bag shortages, things like that. But also on the possible front, Singapore, in my mind, sticks out. It's already a major dollar funding hub for Asia, right next to Strait of Malacca. I think there's a lot of interplay there between the spheres of influence, what Matt's talking about, and then Qatar, Bahrain. These are all again directly impacted by everything going on right now with Iran. So I just wanted to add that in there as a little teaser there. And then Matt, for the EU and US MOU. So this one was interesting to me. I saw this news pop up. What's your read on kind of what this MOU means in terms of this competition over resources?
So we talked about earlier the ECBs and the euro area from an economic standpoint. They're much softer position or ground they're standing on into this little window. And this story here from the EU and US signing an MOU on critical minerals, right? We talked about critical minerals being one of the key inputs into this new vision, the Pax Silica, which encompasses AI supply chains, semiconductors, energy resources, critical minerals and rare earths, and then also the financial layer, which we talked about the dollar swap line story, Bitcoin, et cetera. This is one front on that, right? So the critical minerals we talked about, the existing supply chains are heavily reliant on a small number of production locations for supply. And that is a challenge for the other regional powers, say U.S., EU, et cetera, who are dealing with that key bottleneck, right? Where, it's widely known China has a temporary high ground position, I will say, in the rare earth production and supply chains. It's not insurmountable if you go deep on, the actual managers, production who know this industry. I don't think it's a long-term pain point that the U.S. and other regional powers who cooperate, like the EU, can't resolve for themselves, just given enough time. And we're talking here maybe a couple of years, not multiple decades, right? Okay, so what this EU and US kind of agreement is hinting at for me, this is a positive sign. If you think about this competition, right, all these economies are chasing resources, trying to strengthen their financial system. You can approach it two ways, right? It can turn into war and take a kinetic tone, or you can get a cooperative kind of approach. And these players, while they're still competing, they do work together and they don't, take it that, full on destructive route. So this agreement really was a positive step. EU and the US stepping back from, what's kind of really since Davos in January been a heated, intense kind of undertone in that relationship. This critical minerals deals where they'll agree on things like, say, price floors in each local block, or stockpiling decisions. Well, they'll coordinate with each other so that both sides can get quantities and reserves of these critical minerals that they need. It's a positive framework, or it's a positive development. As the name Pax Silica, if you foot to it, the Pax means peace, right? So it's hopefully it's a hopeful vision that this whole process, we can get through it and let it play out without resorting to a much bigger, world war type of situation. So this was a positive development on that front this week. I think the last story we want to talk about on this front then, when it comes to sovereigns, if the EU, US critical minerals MOU is a demonstration, like in a positive direction, where this doesn't shift to the aggressive or ultimately, in the worst case, say a military front. On the AI space specifically, we saw a couple interesting stories here in terms of the big picture sovereigns, China and then the U.S. Approaching the AI industry in different but similar ways. So I think Cameron, to start off, really interesting development here with the Chinese company, AI company Manus, which was involved in a deal with Meta. Um, that I think has some interesting takeaways here. If you want to
Yeah.
just explore what you saw here.
Yes, and so first off, some context. Manus, I believe in Chinese means hand. Correct me if I'm wrong. I'm sure somebody else knows, but Manus is developing or has developed more autonomous AI agents than what is currently out there, right? So if you think about the big news around OpenClaw and things like that, where you can speak to your agent, tell it, hey, go off and do this thing for me. The goal for Manus is really having effectively an employee at your company that's proactively researching, doing things without you having to actually go and prompt it to go do those things. So, you know, Zuckerberg and Meta have been trying to court China and Chinese companies for a long time. There's been you can go back to the infamous smog jog with Zuck running around Beijing. A lot of stuff going on with him and Xi Jinping. So there's a lot of upfront work that Meta has put in place to try to make a more favorable environment for themselves when doing deals like this in China, right? And also just bringing Facebook and all of Meta's other products into that Chinese market. But really, Beijing, put a firm stance on this one. Said no, we're not going to allow this deal to go through, despite the fact that Meta had already put the bid in. Payments had already gone out to some of the investors in the deal. So I think it'll be interesting to see where the unwind happens, how they're actually going to either claw back those returns or find some other way to smooth this all over. But as of right now, as it stands, China is saying, no, this deal will not go through, unwind it. So there's really three concerns that Beijing has. The first one, the major one, is in their mind the transfer of advanced technology. That's the Manus IP. There's been a little bit of, Singapore washing is what you call it. Basically, Manus has taken their shell company and taken their company that's currently incorporated in China, created a shell company in Singapore, transferred the IP over there, said, hey, no, we're not a Chinese company anymore. We're actually Singaporean, right? So if you think about how this might play out if it was an American company, it's probably very similar, right? They're going to go through the legal channels first, which is what they've done, trying to push and say, no, make the claim this IP is actually Chinese. It should stay within the Chinese state. It needs to stay within our firewall. And then secondarily is the foreign acquisition piece, which goes back to all of these sphere of influence pieces that Matt's been talking about on the oil front just before this, on the critical minerals front. Now it's approaching the AI IP space. And I think that's another space that China is trying to throw its weight around, saying we can actually project power on the legal/IP front to other countries around us, regardless of whether or not they have direct ties to China. Singapore, though, as we all know, a big dollar funding hub across Asia, and a lot of Chinese companies do have Singaporean footprints. So I think this one's an interesting one to watch in terms of how far China is able to actually push their influence over these other countries, and then also to see what the American response is going to be to those policies. And so then the first kind of response that we saw, so I'm going to highlight here, April 27th, 2026, China blocks this Meta acquisition. April 29th, the White House opposes Anthropic's plan to expand access to the Mythos model. In a similar vein, right? This is the United States going to one of our companies who currently needs to find a way to generate more revenue, wanting to expand its access from 50 current companies with access to Mythos, which is their next gen model, currently unavailable to the public, to 70 more companies. And this is the United States doing effectively a similar thing as China, saying, I don't know if we're going to let Anthropic just go out and do whatever they want. We want to have some control over who has access to this model, how it's being used, etc. And so the U.S. is taking that same legal approach, saying there are national security risks with this model being released to the public. We want to make sure that we're, fully aware of the process along the way. So I think that's another one to watch. As we're thinking about the spheres of influence, China, U.S., uh, EU is out there with Mistral. We'll see where they go with that one. But wanted to call out here April 29th, 2026 then is the date on this one. And then the most recent that I have is from April 30th, 2026, is then taking this out of the AI IP space and then directly into the chip space. So US halting orders to Chinese chip firm Hua Hong. This is the second largest chip maker in China. And the Department of Commerce has actually halted shipments of tooling that China needs, that Hua Hong needs, in order to make their next gen advanced chips and ultimately create the next gen models that are going to compete against the US Anthropic, OpenAI companies' models in the future. So again, I think a really interesting development in the AI space, chip space, mimicking what Matt's been talking about across all these other spaces with the spheres of influence, trying to effectively push throw their weight around.
Yep. So the way I view this package of stories, Cameron, and this is in the last week, but think about the two power centers, one in Beijing, one in Washington, D.C. and New York, or I mean, it's just a corridor. Think about it as one thing, if you will. But those two poles are really trying to establish the border where their power projection capabilities can reach to or extend, right? So Beijing trying to cancel an external party from acquiring its own AI resources, human capital, IP, et cetera, and bring it into its own orbit. And then the same thing with the United States with this frontier most advanced model can detect zero-day exploits like no other is my understanding, and is viewed as like an extremely important national security tool. Both these parties are trying to establish that line and exert their power projection and ultimately sovereignty over this space. I think that the key difference, as we're thinking about Pax Silica, right? What is it? It's like an open network of integration between all the different pieces that go into the supply chain and all the steps it takes of value add to start with raw materials, energy inputs, and turn them into AI tools, but also to run them, right? You got to have the energy resources as well. But the open network approach that kind of Pax Silica is taking to this, and you see the adoption coming along with it. I'd be interested to watch if China or the CCP comes up with some framework that can compete with that, because unless you can offer open participants to potentially join and opt in to your model, it's hard to see China competing with that over the long run. So we'll continue to monitor this story from the week-to-week developments. But yeah, Cameron, great point out. This is kind of showing the disequilibrium and disorder in pretty much all fronts, if you think about it: central banking, money markets, capital markets, natural resource markets, and then on the AI competition. We're in this state where things are just volatile, they're unstable, and ultimately we're going to exit and work our way out of them. But for the time being, that day where we move into the next stage is clearly not here yet. And that's where we'll get into our closing story, gold. What is the gold chart showing you? As everybody knows, gold's been in a massive 3-year bull market. This is the log chart, so it doesn't even do justice to the dominating outperformance that gold has had over over its competing currency, the fiat US dollar. But interestingly, since January 28th, Gold has been in a very clear now. Uh, you call it a bull flag, right, at the end of the day here, but it's a downtrend, a consolidation, and what this is reflecting, in my opinion, is each of these players on the global front, the tap for liquidity as growth becomes uncertain, resource access becomes uncertain. Um, Ultimately, this will have to resolve itself. But what gold is telling us here is a very strong signal that we're in that um, intermediate phase of stress that's now materialized into the central banking layer. So gold is your smoking gun here. Um, um, the beatings will continue until morale improves. But once we do get that sign, I think you'll know it when you see it in the headlines. And this unstable uh, quasi equilibrium resolves itself. So I think, not making any predictions here, but I think there's going to be some big developments in the next 3 to 6 months. Don't know what those are until we see them, but in some way, shape, or form, this whole Persian Gulf, Iran situation, all of this instability, I expect it to resolve itself with a pretty significant development on like the historical big picture timescales.
Absolutely. And I think that's a good spot to leave it for the week. A lot of we've covered a lot of ground, Matt, and I know the audience, thank you for sticking with us. A lot of these topics we had to cut ahead of time before we even did this episode. So again, a lot happened this week. So again, as always, thank you for listening. Subscribe to us on MindPrintHash at MindPrintHash on X, on Substack. You can follow Matt on Levered USTs on X, myself, Cameron Otsuka on X. Appreciate all the comments we've got, giving us some feedback, giving us some topics to dive into. And then finally, don't forget, watch Matt's appearance on the Bitcoin layer with Nick Bhatia. I think he did a great job explaining in much more detail kind of what's going on with that UAE dollar funding, Besant, etc., that we touched on briefly during today's episode.
All right. Thanks for grinding that out. That was a long hour plus there. We're hoping to tighten it up, but it's hard to get all these complex topics and wrangled in one take, which is what we record this in. So thanks for sticking with us. We'll see you all next week.